Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone. I'm Kavita Baratake. I'm from Cherry Street Investments, and today's topic is tax savings with opportunity zone investments. So why opportunity zones and how does it help you save on taxes? I started talking about opportunity zone investments in 2018 when it first came out, because I personally had some stock gains of the company RSUs that I vested, and then I sold that stock. I just invested, I sold it. And so that created a capital gains event for me. And I remember back then I had a CPA whom in retrospect I should have not had. And I asked her, how can I get rid of these capital gains? Can you give me some suggestions? And she had nothing. So I started researching what I could do, and I found opportunity zones. I went back to her and I asked her, what do you think about this? And she didn't know anything about it. So at that point, I found another CPA who knew something about it, and I did end up investing in an opportunity zone investment back then in early 2019, February 2019. And so I did a lot of research on my own back then. It was fairly new, regulations were changing, but there has been a lot solidified since then. So I just wanted to take this opportunity to revisit this topic. This is one of the earliest presentations I did with my investors when I started back in 2019 doing with Cherry Street Investments. So I wanted to kind of revisit that topic and put it and introduce you to a lot of investors who might not be aware of this tax saving potential. So with that, I do want to specify a disclaimer. It's very important here, especially when we start talking taxes, that you always consult your own CPA about this, because I only put this together in a very simplified format based on my own experience investing in an opportunity zone, researching opportunity zones. So I want to give you more of a high level 10,000 foot view into this opportunity zone investment and help you evaluate if you can potentially invest in an opportunity zone for some of the capital gains or other gains that you might have. So we'll talk about what kind of earnings or gains can be put in a OZ investment. Not everything is eligible for or qualified as far as OZ is concerned. So do understand that this is only educational, and you should always consult your own CPA or attorney for specific investments or specific tax situations. I'm not a tax advisor. A little bit about me. A lot of you folks on this call already know me. For those who don't, I am a proud Texan, have been in Texas since 1998, have seen it grow and flourish the last 22 years that I've been here, and 23 years now. And I come from a tech background. I spent 20 years in tech, both across IBM and Atlassian. And incidentally, when I sold my Atlassian stocks in 2018, that's when I was hit with a huge capital gain. In retrospect, the stock really went up, so maybe I should have held on to it, but I didn't. I invested it into real estate. No regrets there. So my investing journey has gone through, I've been investing in stocks. I started there. I went into options trading, for those of you who know the ups and downs of options trading. And then I started, lost a lot, made a lot, and lost again, and pretty much came out even when I did the options trading, and then got a little bit more, and then bought my first house in Austin in 2009, and then never looked back from there, because real estate was so stable and I didn't want something which needed a lot of hand holding. So went to landlording from there with single family homes as well as small duplexes, and then got into larger multifamily like apartment investments, opportunity zone investments. I also do some senior living investment, and personally I've invested into ATM and other investments as well. So I started Cherry Street Investments with two fundamental goals. One is investor education, which is, again, continues to be something really important to me, because I found that when I was trying to learn, it was an uphill battle to find information. Maybe because there weren't as many podcasts, as many webinars, as many sources that I could find. So I actually signed up for education and went personally to learn. And my focus was, how can I bring more of these topics to everybody, to lay people who are busy with their jobs and don't always have the time to go out of their way to learn information or to get information. So I focus a lot on investor education and also bring some investment opportunities, as well as I have a life insurance brokerage that I do what's called infinite banking. For those of you not familiar, there's a video on my investor education group on YouTube. I am an active multifamily investor. I have over investments in over 1,500 doors or units of multifamily. So for those of you not familiar, again, you can go and see all the education we've done in the past, which is about 90 plus webinars, maybe 100 now, I can't keep track, on Cherry Street Investor Education on YouTube. The Infinity Banking I mentioned is also there, in addition to others. You can hit the subscribe button and you'll be notified every time of new videos uploaded. And actually will upload this one as well if you want to review it, as well as post links to all the education and blogs that we'll share today during this presentation. Just a few housekeeping rules before we get this started. Everyone is on mute except the host, because it's a webinar format. If you have any issues with the audio or visual at any point, please type it in the chat box and let me know. Also, locate your Q&A box in the Zoom application so you can use that for any questions. It makes it a lot easier to kind of track. And yes, this webinar will be recorded, and I'll send the link out usually within 24 hours. My admin will get it out tomorrow morning generally. To avoid it from going to spam or promotions, please add my email to your contact list. So let's talk about, let's cover the agenda on what we'll be talking over today. What are opportunity zones? Just briefly. Why invest, or why consider even investing in an opportunity zone? What does it get you? What is a qualified opportunity zone? What are some of the compliance requirements? Again, this webinar is geared more towards you, an investor investing in an opportunity zone, not you, an investor who wants to go set up an opportunity zone investment. And there are two different things there. You invest in a fund that is existing versus you setting up your own fund. And let me tell you, setting up your own fund is a lot more complicated, and it involves a lot of compliance and regulatory requirements that you have to adhere to. So it isn't as simple as buying a piece of land and building a shed on it and you're done. It does not qualify. And a lot of brokers have sold opportunity zone land, overpromising, oh my God, it's an opportunity zone investment. So what? It means nothing. So I want to allude to what it means to set up an opportunity zone fund, but understand that this webinar is geared more towards you as an investor investing into an existing fund rather than you going off and doing your own thing. Although you can use this as initial information to go set up your own fund as well. We'll talk a little bit about OZ timelines as well as tax savings. We'll talk about qualified opportunity zone funds and how they differ from 1031 exchanges. Some OZ do's and don'ts and considerations from my own experience of investing in an OZ, and how to evaluate an existing opportunity zone fund. I think this one's really important if you're considering investing in one. How do you do your due diligence on it? I'll again not spend a whole lot of time on that, but I will direct you to resources that you can do a little bit more research. And finally, I have lots of links and resources for you guys to go back and do your own due diligence and research. So Benjamin Franklin said, in this world, nothing can be certain except death and taxes. This was in 1817. And I think that is true for most part. But if you work smart and you know the tax, I wouldn't even call it loopholes, but the tax code really well, there are always ways and means around taxes. Let's just talk about our own former president, right? He didn't pay taxes for quite a few years, and there was nothing illegal about it. I know people like to finger point, but truly he just exploited what was in the tax code. So what's interesting here is, for the first time in history in 2018, the super rich paid at a lower tax rate than the bottom 50% of the earners of the US households. And as a middle class person, we are in probably the worst place with W-2 incomes as far as taxes are concerned. You just get hammered, right? Right in the middle, higher income, so you're in the higher tax brackets, and people in some states like California, on top of the income tax for federal, you're also looking at very high state income taxes. So effectively, half of your income, 40 to 60, 50% of your income is out in taxes. So you're really working for the half, which makes you want to pause and say, wait a minute, what could I do better? So if you look at why the super rich paid a lower tax rate than the bottom 50% of America in 2018, does anyone want to guess why? What did they invest in? You can type it in the chat box. No one? Passive income. No, what specific asset did they invest in to create these tax? Real estate. Yep. They invested in real estate, right? So most of them, real estate is one of those asset classes where it is the best way to create tax breaks, right? And why do people go buy golf courses? Huge depreciation, huge amount, 100% depreciation in golf courses. Did anybody know that? So really, you just have to get a better understanding of the tax code to save on taxes. And I'm not saying we shouldn't pay our due taxes due to keep the country going, but rather figure out how you can keep a little bit more of money you work so hard to make, right? So today's question is there an opportunity for you in an opportunity zone investment? And I hope that you're able to answer this question at the end of this discussion and say, okay, this is something worth exploring, or no, maybe this is not for me, right? So what are opportunity zones? So opportunity zone program itself was created as a part of the TCJA, or Tax Cuts and Jobs Act of 2017. This was put into place actually when Trump was in power. The opportunity zone was a specifically designated census tracts. So it covers, initially it covered 18 states, and it was designated on April 9, 2018. Over a period of time now, we have about 8,700 plus opportunity zones covering all of the 50 states, the District of Columbia, and the 5 US territories. So the purpose is very simple. Identify pieces of land, or identify land that needs to be developed or is not seeing enough capital infusion, and increase that capital infusion to spur economic development in those areas. What does that mean to you? Majority of those census tracts are low income. So that's something you need to watch out for right there. When it's low income, the number one rule in real estate is good location, right? And you have to be really careful, because low income doesn't exactly scream good location. But that said, it could be in the path of progress. It could be, some of these tracts are weird. They're actually in very high income areas. For example, Louisville in Texas, very close to Dallas, is a high income area. It's actually growing, and it's in the path of progress. And majority of Louisville tends to be an opportunity zone. So there are always these things that you don't expect to be an opportunity zone that are. So that's something you want to watch out for. Like, for example, Arizona, Mesa, lots of Mesa was an opportunity zone. And a lot of investors came in early on and bought parts of Mesa that crazy high income there. So bottom line is, it's not true that all are low income, but there are parts that are low income, but in the path of progress. And that's kind of the investment that you want to look for. So going off track there, what is the purpose of this? It's encourage investors to reinvest their capital gains into businesses, real estate, or business assets that are located in an opportunity zone, essentially put more capital into it. Today's talk, as I mentioned earlier, will be focused more from a real estate perspective. I'm not going to get into opportunity zone businesses or business assets. It's sort of outside the scope of my knowledge anyway, so I don't want to jump in where I'm not comfortable. So why invest in an opportunity zone? From your perspective, you get substantial tax benefits, both in form of tax deferrals and adjustment of cost basis. I'll talk through what that means exactly in what year through a timeline. The gains may be deferred, that are deferred can be eligible gains. So what are eligible gains? They include both capital gains as well as qualified 1231 gains. So if you sold a house or a rental property, that would go into a 1231 gain, and real estate gains generally, as well as capital gains. Capital gains can be from any source, right? You can sell stocks, you can sell crypto, you can sell a piece of art, you can sell business. I mean, you can sell a lot of different things to create capital gains, and that can be invested back into an opportunity zone. So normally when you sell stock or crypto, there is really no alternative for you but to pay either short-term or long-term capital gains based on the length of how long your investment was made. So if it's under 1 year, you pay short-term, and if it's over a year, it's a long-term gain. And the long-term gains are usually 15 to 20%, whereas the short-term can be is considered ordinary income in your tax bracket. So what this helps do is basically offset those gains. Not 100%. It's not a 1031 where you never pay those gains, but I'll talk through what the deferral means. It also, in addition to the deferral of those taxes, allows for many benefits over a 10-year hold period. So the whole year is a 10-year period. The incentives are provided at 5, 7, and 10-year thresholds. And again, I have a visual diagram that will make this really clear. So what's an opportunity zone fund? An opportunity zone fund is simply an investment vehicle organized either as a corporation or a partnership. And it is a qualified opportunity zone specifically for real estate. Like I mentioned, it could be business or business assets. We're not going to talk about that today. So a QOF for real estate self-certifies with IRS as an opportunity fund. It's a self-certification process. There's no formal process except for a self-certification. 90% of the funds collected in this fund has to go towards OZ investment. So they can't put less than 90% in an OZ area investment. And it needs to meet what is called a substantial improvement test. And the folks on the OZ guys on the call can also comment on this if anything has changed, because a lot of laws around opportunity zone constantly change. I know that with COVID, they changed a lot of the deadlines and they pushed them out because of COVID. So if there's any error here, please feel free to chime in the chat box, or if you want, you can raise your hand and I'm happy to bring you on. So the substantial improvement test demands that you double your basis in the property within 30 months of acquisition. A lot of people, let's say they go buy multifamily in an opportunity zone. It's really hard to take existing multifamily, which is completely operational, stabilized with tenants, and double your basis. So let's say I bought a multifamily for 10 million, the land was $1 million. Now my cost, my structure basis is $1 million minus, 10 million minus $1 million of land. So I have to put another 9 million into the property to actually meet the substantial improvement test. So it becomes very difficult to meet that opportunity zone substantial improvement test unless you're doing a new build or you're doing a substantial gut job of the project. So let's say I bought a hotel, empty hotel, and I converted it to multifamily. I bought it for 2 million. I put another 2 million into the project. It could meet the substantial improvement test. So you have to be very careful about anybody who advertises opportunity zone, a land or a hotel or anything, a real estate property being in an opportunity zone doesn't mean anything until it meets these tests from a taxation perspective. It does not qualify, okay? So the other question thing here is the majority of the land under consideration has to be in the designated OZ tract, which means if I have 10 acres, more acreage should be in the OZ tract than not. So that's important too. Some of it might be outside of OZ. The tax benefit can be combined with the bonus depreciation. And please ask your questions in the Q&A box and I can come back to it later. So an opportunity zone fund can invest in multiple properties across different OZ areas. That would be ideal. So you have some exposure to multiple locations. You can sell a property in OZ, roll the funds over to another property, but it should also be in an OZ. And there are timelines within which the funds have to be redeployed in the new opportunity zone property. So a qualified opportunity zone, I think we covered this substantial improvement test. We covered all of this. Let's talk about compliance requirements. The funds in an opportunity zone QOF, qualified opportunity fund, have to be deployed within 90 days into a property. So a sponsor cannot just take your funds and sit on it because they have to be deployed within a certain timeline. Now with COVID, some of these timelines have shifted, but as far as I know, since end of March 2021, none of the timelines have shifted as far as these 90-day requirements and 6-month requirements. So you have to put your money into a qualified opportunity zone within 6 months of the taxable event. So let's say you had a capital gains event January 1st, then within June of that 6 months from January 1st, you have to deploy that into an opportunity zone fund to meet this criteria. It's very similar in that sense to 1031, but there is no 45-day identification period here. And we'll compare and contrast 1031 versus this. And also the other big one is, this is not related. This is not just for real estate. 1031 is simply for real estate. So if the QOF does not meet this, they have to be audited every 6 months. So to make sure that they're compliant. And they could be fined if the fund is not keeping up and is not staying compliant. So the rules are constantly changing and people are giving inputs from working groups with large OZ funds as well as OZ advisory firms. And also in the light of COVID, I told you there have been a lot of changes to the deadlines. They have been extended out. But that said, I don't think anything is extended beyond March 31st. So right now, if you want to get into an OZ and you have a particular gain right now, I think the deadline's normal, that's 6 months. So let's talk a little bit about deadlines. So what happens is, let's say you have a capital gains or a 1231 gains event. Now, you have 6 months to deploy those funds into an opportunity fund. Now, once you deploy it, you don't owe taxes on it right away. So the tax liability shifts to end of 2026 or the year the OZ fund is sold. So most OZ funds will be 10 years. So the end is usually not an issue. Nobody's selling it before. But if they do sell it, then you are liable for that gain whenever it's sold. But generally, most OZ funds are set up with a 10-year timeline because they don't want you to, they want you to get the full benefit of the OZ fund, right? So 2026 December, the end of the year, your taxes are due, which means it's due in April the next following year, whatever, whenever you file your taxes. And the 5th to 7th year is interesting because they allow you to do a step up in basis if the asset is held for more than 5 years. So let me give you an example. Let's say my cost basis for an investment was $100,000 and I sold it for $180,000. So my gains are $80,000. My cost basis is $100,000. So what happens in an OZ fund is there's a 10% step up in basis after 5 years. So what that means is your $100,000 basis now becomes $110,000 because it's a 10% step up. What that effectively means is your $80,000 gain now becomes $70,000 because there was a 10% step up in basis. So that's what happens at the 5-year mark. At the 7-year mark, you'll get an additional 5% step up in basis. Here it says a capital gains tax owed, but if you actually go to the IRS regulations, it will talk about it as a step up in basis. So your step up in basis will go from a 100K basis to a 110K basis to 115K in basis, right? So there's a 15% total step up in basis over a 7-year period. So effectively your taxable dollar amount is reduced because of the step up in basis. Also, this is the most important thing in a OZ fund, is that after 10 years, all the growth in that account is tax-free. So let's say you took your $100,000, $180,000 investment and took that 100,000 and spent it, blow it on a vacation, whatever. Didn't matter. You don't have to invest the original basis, right? You have to only invest the gains. That's the huge difference. So your gains were $80,000. You went and put it in an opportunity zone fund. In 10 years, let's say reasonably, every 5 years, let's say doubles. So in 10 years, your 80,000 became 3 times 240K. Now your 240 minus 80 is your gains, and that is tax-free in an opportunity zone investment. And that, my friends, is the real reason why you would invest in an opportunity zone. The deferral of taxes, the step up of basis, it's just little stuff compared to the huge amount of growth that you get to take home tax-free. And also never mind that instead of you paying taxes ahead, pushing the tax timeline down the lane, and I'll show you the number difference, it's substantial. So let's talk about how this translates to a huge difference, right? You had an original gain, let's say, of 200,000. I'm assuming a tax rate of 37, which is pretty high. But folks up here who have high incomes do pay those kinds of taxes. A 10% annual appreciation here, and the original gain is 200,000. The tax on sale on gain in the year of sale is 37. So the tax on the original gain is 74,000, right? Assuming a 37%. Of course, you can adjust it to your own tax bracket. So your amount reinvested that you can invest is 200 minus 74. Okay. Now, the value of this 126 in 10 years, assuming a 10% appreciation annually, is 326K. Now, you also have to pay taxes on that appreciation in 10 years from 126 to 326. That's another $74,000, right? So your net return now becomes 252. Now, let's assume that you do the opportunity zone investment in the same case. So you have a net tax gain of 0 in the year of sale. Now, remember, the taxes are deferred. They're not 0, really. They're just deferred in the year from the year of sale to December 2026, right? So now, but the advantage of that is now you get to invest the entire 200,000, right? The power of compounding. Now, instead of investing 126, you're investing 200K. Now, your value in 10 years is going to be at the same compound because the initial amount of investment increased so much. Your value is going to be 518 at the same tax rate and the same appreciation. Also remember, there is no taxes on the gain, right? But you do have to pay taxes on the deferred. You instead of paying 0 here, it's actually a 15% step up in basis, and you'll pay 62,900 instead of 74. It seems like, oh, you didn't save a whole lot. That's right. But what you did save is no taxes on that growth, right? And you got to invest your entire amount here. So effectively, your net return now becomes 455, 848. These two, right? With and without opportunity zone. And effectively, you have just gotten 1.8x growth just by using an OZ fund. So it can be very powerful if you know how to use it, and if you use it well. Especially useful if you have short-term gains on sales, because you obviously want to pay a high tax rate on short-term gains, right? So let's talk about what's QOF. What's the difference between qualified opportunity zone fund and 1031 exchanges? The big difference is here you only have to take the gains from a capital gains event. Here, you have to move the entire proceeds in 1031. Like everything you've sold has to be moved over, and you also have to place a mortgage equivalent to what you had in the previous property. So it tends to be very messy at best when you do a 1031 exchange, and you can take what's called a boot, which means you take some money out, but you will pay taxes on it. So generally, all the proceeds need to be rolled. And the other thing is, you don't need a custodian here. You could sell something, keep the money with you, and invest. Here, you cannot touch the money when you do a 1031 exchange. It has to flow through someone called a 1031 intermediary. They need to keep the money in their account on sale, and you can't touch it. You can only move that money. They can only move that money into the new property when you have identified the property and you're making the purchase. The other thing here is the capital gains can be from any source in Opportunity Zone Fund. Here, it can only be from a real estate sale. The investment deadlines are pretty much the same, 180 days from the capital gains event, but the 1031 exchange has an additional requirement of 45 days to identify candidate properties. They usually ask you to identify at least 3 candidate properties that you might buy. The investment location, significant improvement might be required in an OZ area. You cannot just go put money anywhere. It has to be an OZ area. It might be good, it might be bad. You have to do some due diligence on that. There is no location preference in 1031. You can put the money anywhere as long as it's a real estate transaction. You can put it in multifamily, senior living, it doesn't really matter. The minimum hold period to get the full benefits of OZ is 10 years. Right? You do get a step up in basis at 5-7 years, but 10 years is when you will get a tax-free withdrawal of all the gains, or rather, actually, your cost basis gets stepped up. The minimum hold, there is no minimum hold. You can indefinitely 1031 it. The caveat being, Biden is talking about removing 1031, or at least modifying the 1031 laws in some way, especially for the high income earners. I think it's above $500,000. We are likely to see some changes for 1031 exchanges. We don't know what yet. So investing in an OZ fund, some of the do's, you have to make it an equity investment. You cannot do it as a debt. A debt means, let's say you're loaning money to an Opportunity Zone project. They can't pay you a flat 10% and you're done, right? They cannot do that kind of debt thing. You have to be an equity holder in the project. You can only invest, you can invest only a part of the gain, invest multiple gains, make multiple investments over time. There's a lot of flexibility here. Roll the gains over into new fund investments. It's all up to you, right? How much and how you can take a part of it. So what I did was I took only my short-term gains and put it in an Opportunity Zone fund. I didn't think I wanted to lock up my long-term gains just to save 15-20% in taxes. So I chose to pay a part of the taxes and take Opportunity Zone for the short-term gains. So you might want to decide if it's worth locking up for 10 years. So you must actively make an election to defer your gain using a form. And again, your CPA will know what form needs to be used, that you file with the tax return for the year in which the gain has occurred. If the date of the gain is at the end of the tax year and you haven't made a final decision, it's important for you to extend the filing date of your tax return so you can submit that election saying, I am investing in an Opportunity Zone. So some of the don'ts: don't invest in an OZ fund just to save on taxes. It needs to be first a good investment first. It needs to pass the good investment test before it passes the, oh, it saves me taxes test, right? Opportunity Zone areas, like Seema pointed out, they are low income areas generally and not usually the best locations, although there are various exceptions there. At least do your due diligence to make sure that it's in the path of progress, it's gentrifying, and there is a potential for you to make money in the long term. Because the way I look at it, there's no point in saving taxes if you're going to lose that in your investment, right? Lose that and then some. So don't rush into an Opportunity Zone investment. Don't overpay for land. If you're intending to buy a land and do an OZ fund yourself, don't overpay for the land. A lot of brokers will advertise land as OZ land and then try to sell you on it. Worst investment ever. Like I said, there's a lot of criteria to be met before you qualify as an opportunity zone. So you want to make sure that the land not only pay a good basis for the land, and then the tax saving is just the cherry on top. It's not the cake itself, right? And if you're going to invest in an existing opportunity zone fund, don't pick a random operator and invest. Do your due diligence on the sponsor and see what investments they've done before. How have they turned out? What is their returns? Are they going to pay you taxes? Are they going to pay you money so your time and your taxes are due? And I'll have a page, I'll talk about doing your due diligence, and also look at the location and say, okay, look at the median income. Go to a website like city-data.com. It'll give you a lot of, if you type in an address, it'll give you a lot of information about the location, including median income, demographic data, just important stuff about the location. And I think that's really, really more so important in an opportunity zone than regular investments. So how do you evaluate a qualified opportunity zone investment? I break it down in different things. We talk about the sponsor first, the location, the deal, and the other opportunity zone specific things there might be. So sponsor, again, in any investment, I think these are really important. Opportunity zone, more important, right? Because you most likely don't know the sponsor, or you might not have a deep connection with the sponsor. So you look at their track record. If they don't have a lot of OZ investments, look at their track record in non-OZ investments. I mean, really from their perspective, except for the compliance requirements, their work is still the same, whether it's an OZ or a non-OZ investment, right? So look at the track record, ask for the track record. Look at the asset classes that you're investing into. Is it a good time to invest in the asset class? It might be a great time to invest into student housing right now. I don't know, but it might also be one of those things. Long term, we'll be out of COVID and it'll be fine, but short term, we don't know the pain, right? We are in for. Knowledge of OZ regulations. Do they know what OZ is? Are they pretty aware of OZ? A lot of, when I interviewed the sponsors, a lot of them didn't even know a whole lot. And I'm like, I'm not sold on that if you haven't done your research, right? Communication responsiveness of the team overall. Location is important. What is that fund targeting? Market and sub-market wise, what's the median income, what's the crime rate, what's the poverty rate? Again, city-data.com, all that information is available immediately. Just type in the zip code or the property address. You do want to figure out where that fund is planning to invest, and it can be multiple markets and sub-markets, right? Asset classes invested, is it a multiple property investment in the fund or a single property fund? That's important. If it's a single property fund, you are risking everything and betting everything on that one property, right? Is it a new construction? Is it a heavy value add project? Is it a conversion project? Heavy value add project might be a little less risky just because of new construction coming with its own set of risks. There might be other considerations. There's fees and overhead, which is typically high for new construction because there's like a 4% construction management cost up front. There's ongoing construction management fees. You want to figure out what the distribution timeline is. So your taxes are due December 2026. You don't want to be hit with a big tax bill and not know if your sponsor is going to do any payouts before that. So you want to ask them how and can they cover your tax liability? Will there be distributions? What is their exit strategy? Do they plan to refinance? Do they plan to roll over to another property? So if you're interested, actually, I'll be sharing this entire presentation as a PDF, and you can click on that link. I actually wrote a blog about doing due diligence on opportunity zone investments. This was from 2019. Might be a few things a little outdated, but majority of the due diligence still stays the same, but regardless of whether it's 2021 or 2019. Other factors to consider, I think these are super important. Would I make this investment if it wasn't for the tax benefits? Is it a long hold period? Is the long hold period, which is 10 years, on the loss of liquidity acceptable to me? Do I want to lock up that cash, or do I just want to pay taxes on it right now? Where will the market be in 10 years? We don't know, right? There's a lot of uncertainty there. Can my money work better for me in another investment with a potentially higher IRR? So some of the opportunity zone investments give you really poor IRRs, maybe 10, 12 or less. Versus, let's say you go into traditional multifamily, you might get a much higher IRR. I think that's especially important if you're looking at, is this a real estate gain or is this a stock market gain? If you're stock market gain, you really don't have any other option to get rid of the gain. If it's real estate gain, you could potentially just invest in a regular investment, have depreciation benefits and offset some of your gains, right? So there's always other options with real estate gains besides 1031 exchange. So if you missed your 1031 exchange window, maybe this could be the right investment for you, but your custodian will usually lock up your funds for a certain period before they release it. So you have to kind of check with them on that. Can I make use of depreciation for real estate gains instead of OZ? And I spoke about this. Also, is this the right fit for a long-term capital gain, or do you just want to pay the gains? Or is this better, much better, I think, for short-term capital gains? But again, it's your call, right? So here are some of the important links. I don't expect you to go through them, but I'll just send it out. If you guys are interested, you can look through it. And with that, I'm going to open it up to questions. Right. Let's see here. Vijay asked, is QOZ more in compliance with regulations versus OZ? I'm not sure I understand your question. A qualified OZ is the only kind of OZ that is qualified to give you the tax benefits. You have to set up a QOZ fund or a QOZ business of some sort to qualify for the tax cuts. An OZ by itself doesn't do anything. It's just a piece of land. It's identified as an opportunity zone. It doesn't give you any tax benefits of just, if you go buy land in an OZ, zero tax benefits. Until you do all the requirements to make it comply with the QOZ requirements, your piece of land is just a piece of land. I hope that answers your question. Anu asked a few questions. What's the expected rate of return? I don't have an investment here. Generally, I've noticed that the QOZ funds offer less IRR than non-OZ funds, generally. Because of the tax benefits, they feel like, okay, we can offer lesser IRRs. What happens if you hold for the entire term? No taxes on initial capital gain and no tax on the OZ fund returns? No. You will still pay taxes on the initial capital gain, but your cost basis will be stepped up 15%. So your $100,000 basis now becomes 115. And if you made an $80,000 gain, essentially your $80,000 gain reduces by $15,000. So $65,000, right? So it does not remove your tax liability for your original gain. It only takes away your tax liability for the OZ fund returns. I just want to clarify that. Can bonus depreciation in OZ fund offset W2 income? Generally, bonus depreciation cannot offset W2 income because it's a passive loss, unless you are a qualified real estate professional for tax purposes, in which case you wouldn't have a W2 income. Or you might have a W2 income if your spouse has W2 income and you are a qualified real estate professional, in which case all your passive losses become active. So normally the answer is no, to the best of my knowledge. This is based on short-term gains versus long-term gains. You can defer both short-term and long-term gains in an OZ fund. There is no guidance on that. Like, it doesn't have to be one or the other. You can defer both, but I think there's more value in deferring short-term because they are your ordinary income tax, which is likely to be higher. What tax implication if OZ property is sold before 10 years? So you don't get that benefit of no taxes. You will have to pay taxes on the OZ if it's sold before 10 years. Most OZ funds don't plan to sell it for that particular reason, because you want to hit that goal because you want that tax-free growth. Renee asks, can you invest non-gains in an opportunity zone? Yeah, meaning I'm not selling an asset to invest. I would be pulling from money market versus sale of the asset. There is no value in doing that, Renee. I would rather you go invest in a regular investment because it's going to give you a much better IRR than putting it in an opportunity zone. Most opportunity zone funds will not take your non-gains because they have people who really have gains and who need it to offset. That said, I think they will allow some combination of gains and non-gains in case you want to increase your investment amount. I don't think they'll say no to that. But to be honest, I would not put anything more than gains into the opportunity zone fund because that's when you're really getting a bang for your buck. You take the non-gains and go put them in a regular fund, you're going to get better returns. What is the site for market research for a specific zip? It's city-data.com. How do we do due diligence? Are there sites that compare financial fundamentals and regulatory compliance? Oh, yeah, no, there isn't. So I think one of the things I did, Vijay, was I figured out what areas I started here, right? I started looking at what areas they're investing in, what assets they're investing in. Those are two factors that I felt like I wanted to I wanted exposure to. Like I did not want to invest in New York or San Francisco. And hindsight, probably a great idea because what happened to COVID, yeah, San Francisco, New York. But in my opinion, those were really low cap markets that I didn't want exposure to. So I stayed away from LA, San Francisco, New York, all the big cities. I wanted to invest in Sunbelt states, New York, I mean, California, no California, Phoenix, Arizona, Florida, Texas, Georgia. So those were states I kept, and Tennessee as well. Tennessee and Midwest has had a nice growth in the last 5 years. So I kept that in mind. And I started narrowing down my search using that. Then when I had a narrower search, then I started looking at the asset classes that I wanted to be in. And then I've narrowed it down some more because there were some asset classes I didn't want to touch. So all of that stuff happened. And then finally I narrowed it down to, I interviewed about 10 operators and some of them didn't know what the hell they were doing. And so I chucked them and I got down to a couple of funds at that time. And then I picked one of them called Virtua. Not endorsing them, they haven't paid a dime yet. So we will see how that goes. They're still in the construction phase. It's been a few years, but the locations have done really well. So I'm hoping there'll be a good payout. Tima is asking, am I setting up a fund? No specific plans, but I do have some friends who are running funds. I don't endorse them one way or the other because I don't really haven't done my due diligence on it. But no, I'm not setting up a fund. Where did you find the OZ? Is there a national OZ map? Yes, there is a national OZ map. If you just say opportunity zone maps, you'll find plenty of it. You can actually go there by address and say, search this address, is it an OZ? Is there a minimum funding or any other requirements as an investor to qualify to invest in an OZ? Yes, there is. Most funds will have $100,000 minimum. I think 50 in some cases. 50 to 100,000 is a good number. Some of them said $500,000. I'm like, okay, maybe that's not for me, right? I didn't have $500,000 to fund into an OZ, thankfully. The other requirement I found is a lot of them were taking only accredited investors. That was because they were public funds, right? So whenever you are generally advertising or doing general solicitation, they have to be a accredited investor only fund, 506C fund. So those were some of the limitations. I think I covered that. And QOZ funds ask for a minimum 100K. Is that the norm? That's sort of correct. There are some which will do 50,000, but 100 tends to be the norm. You can negotiate with them. If you take money out for one OZ investment and put it in another and so on, but the overall term you maintained is 10 years, does this qualify for tax-free gain? or you must stay invested in the same project. You can go from one investment to another, but generally a sponsor has to do that. You can do that. You can tell a sponsor that you've invested with and say in 2 years, hey, give my money back. I'm going to go invest into another OZ. You can do that. If you're in an OZ, let's say you're setting up your own fund, Snehal, and you go sell that OZ investment, you have to redeploy it into an OZ investment within 24 months, I believe. And you can continue to do that over the 10-year period. But if you are investing in someone else's OZ fund, you can't just ask for the money back. They're not going to give it to you. If they have a timeline, they're going to maintain that timeline. If they have an option to sell, and then they'll redeploy the funds into another investment and they'll keep your OZ status. I hope that answers your question. Vijay is sharing an opportunitydb.com. I'm not really sure what that is, but feel free to go check that out. Any minimum funding? I think I've answered that. Does Cherry Street do consulting for OZ funds? Do we contact you for more information? I don't really consult for OZ funds. I do consult by the hour, but not specifically for OZs. I would just say, do your own due diligence. If you need an hour or two from me, I'm happy to consult for 2 hours, but that'll be paid consulting. Shri Krishna asks, is there a sunset period for OZ funds investing? So the way I look at it, I think someone on the call who knows can answer this. I think your tax liability is due December 2026, right? To me, you lose your tax deferral status after that. I don't know if there's a whole lot of value. At some point, they are going to sunset it. I think a big value still is that 10-year gains without taxes, right? The gains in the thing, in the fund itself. I don't know exactly when they're going to sunset the program. So we asked, maybe already covered this, but you have to decide if you'll put the gains in an OZ before selling the real estate. I think the title company needs to know this at sale. So we not for OZ. The title company needs to know that only for 1031 exchanges, because you have to actually do that before the sale, and the money will go to an intermediary, and that intermediary will hold on to your funds for 1031 exchanges. This is not true for opportunity zones. You can sell as long as it's within 6 months. You can deploy the funds into an OZ and still get your. See, there is a difference between 1031 and OZ. In OZ, you're deferring taxes. You're not getting rid of taxes, but you're growing money tax-free in the fund itself. So it's a very different program. You just have to understand the pros and cons of each. 1031 is generally more advantageous for real estate sale, but it also tends to be a headache. And if you've missed your 1031 deadline, or you didn't even consider 1031, you sold it already, this might be a good one. But if you can 1031 and you have done your identification period and met all the requirements for 1031, in 1031, you don't pay taxes again ever until you sell the property, right? So that gives you a lot more benefit than just saying, okay, I'm just going to defer taxes till 2026. Hopefully I answered all your questions. Any other questions today? I think I got all the questions here. I don't see anything else I missed. I'm checking both the windows. Can you talk? Okay, I think this is the same question. Can you talk about whether bonus depreciation of OZ real estate offsets regular W2 income? I don't think it does. Bonus depreciation is passive loss, and it only offsets passive income unless you're a qualified real estate professional for tax purposes. Anonymous asks, I bought a good primary residence with my savings in a pretty good area. Incidentally, the property happens to be an OZ. Is there any way I can make use of the tax benefit? Interesting. Is there enough land to build something there, right? Could you do an improvement which doubles your cost basis in the property? There is, and it also has to be bought. it depends on when you bought that land as well. So you can take, I don't know the exact date, but there is a date before which if you bought the property, you cannot do anything with OZ. So if you can add on to the property, but it needs to double your basis. So let me give you an example. Let's say you bought it for 200,000 and the land value is like 25,000. Your basis is now 175 in the structure. You have to double your basis. You have to put another 175K into the property. To double your basis, you have to set up a fund. And I don't think you can have it as a primary residence while you do that. So you might have to move out of there. So you'll have to talk to a CPA on that, but it's possible that you can do something with it. But I don't believe you can do it while it's your primary residence. Your vacation rental in the OZ zone, how is it taxed? This will have rental income. So again, Snehal, if it's just because it's an OZ zone, it doesn't mean anything. So if you bought a property, it's a vacation rental, it's sitting in an OZ, it's just another property, right? It's taxed, just like short-term income is taxed. That you've been paying tax forever. The only benefit is if you follow the rules and regulations of the fund in doubling your basis and meeting the substantial improvement test, set up an OZ fund, and that will show that the OZ fund is invested in this vacation rental. So there's a lot of work you have to do around it. It isn't worth it for a couple of $1,000s because the regulatory requirements are going to cost more than $10,000, $20,000 for you. So you have to look at the trade-off and see if it's worthwhile. So if Anonymous bought it this month, you possibly can double. If you can double your basis by just building another flat, it's something you should consult your CPA and see if and do your numbers and see if you can double your basis. All right. Any other questions here? Cool. I think that's it for today. Thank you everyone for calling in here. I hope this was useful, at least as an introduction to OZ. And I am not going to give you any OZ recommendations on this because I haven't done my research on the latest OZ funds either. So someone is asking, is there any big name funds to shy away? I don't know what's going on in the OZ world as far as the newest OZs. But I just wanted to share my knowledge on OZs and my personal experience of investing in an OZ. I hope this was useful, and I will share some links with you guys so you can go do your own research. And this will come in an email along with the links to the webinar recording. I hope this was, again, good use of your time spending with me. Have a good evening, everyone, and thank you. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.